options is historically we've always struggled to get clients are aware of options, but perhaps been slightly scared. Oh, it's a bit too complicated and I don't understand everything. So we all have to start off from somewhere. No one's born an expert. So if you're tempted, give that course a try.
Now, what we are doing here is our beginner's guide. This is lesson number 3, Elliot. We're looking at intrinsic and extrinsic value today. So what does that actually mean? Well, now you understand the basics of call and put options. We're going to delve deeper into the mechanics of options trading. We're going to introduce the concept of intrinsic and extrinsic value, so you can start to build up an idea of what makes up that price that you're trading. An options premium, the debit paid if you're buying, the credit received if you're selling options, is comprised of intrinsic and extrinsic value. These concepts are fundamental to understanding how options are priced and how they behave in the market.
Right, so I'll do this one. So let's look at intrinsic value first. So we can think of this as the optionality part of the options price. So again, we break this down into intrinsic and extrinsic value. So the intrinsic part you can calculate as the inherent worth of an option at expiration. How much value would the option have if you were to expire at this point in time at the current price? Okay, so for call options, extrinsic value exists when the stock price is over and above the strike price. Whereas for put options, the intrinsic value is when the stock price is below the strike price. Okay, so in both those instances, the options would be said to have some options value, some optionality, and this kind of hints onto the theme of at the money, which is a term hopefully most of our viewers have heard. So at the money, in the money, and out of the money. These are 3 terms which give us a rough idea of the intrinsic or the optionality of the actual value of the option.
So yeah, so if you see ATM somewhere, it doesn't mean that somebody's about to spit some cash out of a machine somewhere. That is at the money.
That'd be a nice find.
So yeah, what about the extrinsic value, right? That's that additional value of an option beyond its intrinsic worth. So when it's out of the money or at the money, what influences the value? Well, it's influenced by the time remaining until expiration, and the market's expectations of future stock movements, right? So dividends, interest rates, and of course around the vol as well. So the longer the time until an option expires, the greater its extrinsic value, as there's more opportunity for the stock to move favorably and move up and down. The implied vol, the extrinsic value, is also affected by this. Right, that reflects the market's anticipation of potential stock price fluctuations. Higher implied volatility increases the option extrinsic value. Right, now that's really important. The higher the vol, the higher the option's extrinsic value, everything else being equal. So important for traders, understanding extrinsic value helps traders evaluate an option's total price, manage risk, and make informed decisions about entering or exiting positions before expiration. And of course, at expiration, the extrinsic value is always 0.
Yes, just before we go on to this, if I can just jump in here and just say, why do we care about this figure, this extrinsic value? This is to do with the concept of theta. Okay, so theta is a Greek, which you can see on the Tasty platform. That tells you how much the value of the option is going to change given 1 day's passing. Now, if you've got 80 days worth of time value left, if you lose a single day, you're not too fussed. You've still got 79 days to go until the expiry of this option. If you've got 2 days to go and you lose a day, that's 50% of your time value. So what you generally see is theta explodes as you get towards expiry, just because the chances of the option having any value now, as each day passes, materially decreases.
Now you see why we've invited the expert along to give these lessons, albeit a very early stage in your journey to learning these things. if a stock XYZ is trading at 50 bucks, a $48 strike call might be trading for $2.50, since the call option must have $2 of intrinsic value, right? It's $2 in the money. It must have 50 cents of extrinsic value if it's trading for $2.50 right now. But what about the $53 strike put? Could be trading for $3.25. So likewise, the put option's $3 of intrinsic value, right? Because it's a put this time, remember. So it's the $53 put and the $48 call with the current price at 50. So the put option's got $3 and it must have 25 cents of its extrinsic value. So a $45 strike put or a 55 strike call might have 50 cents of value, but all of that is extrinsic, right? Because those are the out of the money options.
Exactly, yeah. So the extrinsic value will always be greatest at the money. That is where we're most susceptible to theta changing, essentially. As you get towards either side of the curve, so deeper in the money or deeper out of the money, then that extrinsic value begins to decrease and will eventually, on the far right wings, tend to zero.
So options that do not have intrinsic value usually have some sort of extrinsic value, and there's still a chance the option, depending on the time and how far away they are, you still got that chance. So when it comes down to option premium, is really just made up of one plus the other. The total option premium, you just want to figure out what the extrinsic value is. You can subtract the intrinsic value from the premium price. Okay, so option premium minus intrinsic value equals that extrinsic value. But you can find that on the Tasty platform. It's all done for you. That's right, the EXT in this yellow circle here that's been highlighted, that is the extrinsic value for this 612 put for February. So that is the current
just
spider.
On that screenshot, if you could just point to where theta is.
Theta down here.
Yeah, so this basically gives you an idea of how much the value of your portfolio will change each day. Okay, so if you're an option seller, theta will generally work in your favor as each day passes. Then the time value decreases. That is how much you are technically gaining purely from time each day. If you're an option buyer, that's how much the value of your position or portfolio of trades is actually decreasing as each day passes.
And that's the great thing when you get that total portfolio together, isn't it, Elliot? You know exactly what your net theta is.
Absolutely, yeah. Yeah, so leads on to other Greeks, Vega as well, which is how much is your book going to change in terms of volatility, which I think we'll be coming on to in future courses. But in terms of this one, purely focusing on the effect of time value or extrinsic value.
Great, so that's what that EXT is down the bottom of your trade page. So takeaways: intrinsic, the real worth of an option at expiration; extrinsic, the additional worth based upon the time to expiration, market expectation, implied vols, and increasing more with time and higher volatility. The option premium is composed of intrinsic and extrinsic, and you can find out by subtracting intrinsic value from the total premium, and even options without intrinsic value still have some extrinsic value.